Welcome to Beanstalk, M&J's podcast where we are sharing and showcasing our areas of expertise through conversations with practice leaders on their knowledge and experience. At financial institutions, loan portfolios are the most crucial asset group on the balance sheet. They represent an institution's earning assets, but they also represent exposure to risk. So we have specialists at Mauldin Jenkins who work with the leaders of financial institutions to help navigate those risks and maximize that value. And I'm very excited today to be joined by the leader of that practice segment, Jay Lucas. Hey, Jay.
Thank you, Brandon. I appreciate you having me here today.
Well, Jay, thank you so much for joining me. And will you do me a favor and just give, for our listeners, a brief background on your experience and your role at Mauldin Jenkins?
Absolutely, Brandon. Thank you for having me, first of all. But I'm Director of Risk and Advisory Practice. I head up our financial institution practice as far as the credit and SBA space. This is my 30th year, so I have a little bit of a different background. I come from the banking side. I started out as a consumer lender in my early 20s. And I've kind of grown up through that process. I migrated into the risk side of things, and then I had a background in corporate investigations through the last recession. And so I've had a little bit of everything, and so it kind of opens it up to to grow and evolve and to see a lot of different things in a different light.
Well, and let's drill into that kind of expertise, because you have a tremendous amount of expertise and work with a lot of financial institutions to help them navigate big questions and strategic efforts, especially when it comes to their, as I called it earlier, their most crucial asset group, their loans. So just help me drill in a little bit. What are the kinds of services that you offer, the primary ways you're working with and helping financial institutions?
Well, the most traditional, or as I refer to, kind of the bread and butter, is just traditional commercial loan review. An independent third-party review is what most financial institutions need to get a real understanding of how their portfolio is. Those can be performed annually, monthly, quarterly, whatever the case is based on the institution. But that's our primary service. And then obviously we've grown and evolved into the SBA space. SBA is a multi-billion-dollar a year industry. A lot of compliance around that, and we've got some expertise built into that area. And then we also have a big M&A group. So we're very fortunate that we have a very, very deep bench that we can help in the M&A space as far as, potential acquisitions, whether you're on the buy-sell side, it doesn't really matter. So those are the three major things that we can assist with.
So overarching loan review, just kind of taking a look at the portfolio, making sure we are where we need to be, but also kind of taking a level deeper where needed, like you mentioned, SBA, to see other compliance requirements around this. Let's focus on those too. Now, is this largely just kind of check the box, or is there more to it than that?
Well, there's two completely different approaches. So on the commercial side, it's definitely more of a underwriting. We're looking at, how was it underwritten? How is the cash flow analysis? What is the financial reporting on the borrowers and the guarantors or the sponsors, if you will? On the SBA side, it does tend to be a little bit more checklist, because there are very specific documentation requirements. There's certain loan authorizations that have to be gone through. So the approaches are a little bit different, but the overall reaching aspect is, one, am I protecting my guarantee, and I'm protecting my bank's asset. Right. So it's kind of a hand-in-hand approach on some of them.
And then I can't think about loans without thinking about things like covenants and collateral. Where does that kind of stuff come into play with all this?
Yeah, covenants, when you get into your larger institutions that do a little bit more, I'd say, sophisticated lending, you'll have covenants based on cash flow, liquidity requirements, leverage ratios, debt ratios, things of that nature. And they'll put these in these loan covenants. And these could be, event of default triggers. So as part of the review, we're looking at how was the loan approved, and what are those covenants within those loans, and is the client maintaining them? So as far as those kind of triggers, those are some kind of easy things that you can look for, and to make sure that the institutions, kind of managing the relationship as they spell it out, up front.
And I've just been curious too, are those pretty standard across all loans? Like what kind of collateral is required and what kind of covenants institutions require? Or is that almost like representative of an institution's culture, their geography, or just the specific relationship with a client?
Yeah, well, it is very different. So some institutions are kind of check the box as far as the loan policy. It's a commercial real estate loan? Did we margin at 80% loan to value? And that's kind of set it forget it approach, because we know what we have. When you're doing more, so like South Florida, we got some large sophisticated borrowers that have a multitude of businesses that they're in. So covenants are very important, because they're managing seasonality, they're managing inventory levels, a couple of different things. So it really does depend on the institution's credit culture and what the risk appetite is, because it does change from institution to institution.
Yeah, because I've met with Robert Stevens, the leader of our CAS group, quite a bit, who does outsourced CFO and fractional CFO type services. And I know he helps a lot of businesses try and get loans. So I figure, it's just kind of interesting to get a peek behind the curtain at how financial institutions work and what the businesses we work with on that side of the house might be kind of encountering when working with their financial institution relationships. Now, when I think banks too, and all of this, policies and procedures comes to mind. Is that something that you pay attention to? It sounds like you kind of have to, based off of what we were just describing. What is your policy around things like a covenant, or what kind of collateral require in different situations? Is that sort of thing pretty well documented, or is it just known at an institution?
Yeah. In our space, like any other audit division of the firm, we have a PBC list provided by client. And, so there's 15 or 20 things that we're going to ask for every single engagement. One of them is your loan policy. We have to put in our review if we have a policy, and when was the review? It has to be reviewed annually. So as part of that review, some of our clients want us to review the policy in its entirety every year to make sure it's still relevant. Things change, regulatory issues change. And so the policy is very important, and it's also very important to ensure that the board's approved it on a regular basis. So we do look at the policy, and then we do, like I said, we ask for a lot of different things, but the policy and procedures is kind of the starting point of any good audit.
Well, and that's probably really valuable to your clients too, because obviously, mandating needing to have a policy, that makes sense. And then also best practice, reviewing it every year, that makes sense. But what are we reviewing it for? What are we considering? So that's where you can come in to help take a look at it.
Yeah, so regulators, they're just like any other, organization. They have policy changes and shifts, and certain things may be important to them this year, but not important to them next year. So if you've increased your residential construction, is your policy sufficient enough now to that level of lending? If you've started doing more commercial real estate, do you have an environmental policy? Do you even have an environmental policy? So we've actually seen some institutions that didn't even have an environmental policy other than we'll consider it. So we do make those recommendations, and we do work with them to make sure that their policies are consistent with the type of portfolio, because they evolve over time.
Yeah. Well, I imagine that happens quite a bit where we just have a complete gap in our policy, like the environmental situation you just discussed. Are there other kind of common things you find that are missing from policies that would probably be a good idea to have in them?
Well, SBA, so a lot of times they will have a snippet about government guaranteed lending. And so if you're really going to grow that book of business, some institutions may only have 5 or 10, 15 SBA loans, but if you're really going to grow that, you probably need to have a separate SBA lending policy. So there's certain at some point where a 20, 30 page generic loan policy is no longer going to be sufficient. You'll as you grow, you're going to need to have a CRE policy. You're going to need to have an ADC policy. So those are just some of the things where they're not really deficient. They just haven't evolved as the institution has.
Yeah, that makes sense, because you're saying earlier too, even just from the the loan review perspective, when you get into different government loans, that adds more compliance we need to keep in tune with and in mind. So also consider those and then institutionalize them in policy too.
Right.
So Jay, I'm also curious just about what kind of bank you work with, what kind of financial institution you work with, size, location, geography, all that kind of stuff. Just give me some background on, kind of who you're typically engaged to help.
Well, as a firm, we have clients up to $10 billion in assets. So, we have some very large institutions we do business with. As far as me specifically in our practice, typically we're going to deal with $3 billion and less. And everybody says, well, how'd you come up with that number? Well, once you get over $3 billion, they tend to bring more of these functions in-house, and they'll have their own internal audit group that reports straight to the audit committee. But as far as, the size, we go from de novo, from the infancy stage when you don't even have that loan policy yet. Like I said, all the way up to $3-4 billion institutions we help with. From a practice standpoint, our practice tends to be more national. We are not a Georgia firm. We're not a Birmingham, Alabama firm. We are truly a national practice. We've got clients all the way in Neosho, Missouri, South Florida. We have a client in Illinois, one in Massachusetts, Virginia. So we do take it more of a national standpoint, which gives us an opportunity to get kind of really see how the overall banking economy is doing, to be honest with you.
Yeah, absolutely. So de novo, remind me, that just means a bank's just getting started, right?
Yeah, it's just getting started up to about 3 years, and they're still considered in that infancy stage. They're a lot more scrutiny. They just raised their capital, and they just started out lending a little bit. So some are more aggressive than others and have some pretty lofty goals, and some are, hey, we're just filling a need for our community. So we can help at really either one of those levels.
And then the real large institutions, it makes sense that they really have to beef up their own internal departments to keep track of everything they need to keep track of. But do you ever find even they reach out to you for help?
Yeah, we've had a couple of institutions. We actually had one that was almost $14 billion in assets. They acquired an asset-based lending firm. So they wanted us to come in and look at a targeted review. We helped just, on that particular portfolio to make sure that the policy and procedures were in place, that their safety guards matched with the institutions, what they thought they were acquiring. But yeah, we've done some targeted as far as CRE risk assessments, things of that nature. So when they get over a certain point, if you hit that concentration button we talked about earlier, we'll just come in and say, hey, okay, have your policies and procedures, have you updated them enough to keep the regulators, a comfort level there.
Yeah. Absolutely. And then really that kind of that bread and butter, that kind of $3 billion and less kind of target for the full scope of being able to provide a lot of support and value to across the gamut. Now, I am curious. I know you work with a lot of financial institutions, like you said, nationally and all shapes and sizes, but just is it pretty easy for you to get a sense of something like credit culture?
It is. Some are better than others. But no, as a whole, the credit culture is pretty easy because, like I talked about, that PBC list, things we're asking for from the client. And you can tell the quality of the reports you're getting, the quality of the information they're providing, because we got to pick a sample. So we're trying to get a loan trial with some specific data points on it. And so we can't pull those loan trials if we don't have good information. And so you can get a pretty good threshold comfort level up front just on the information that they're providing up front.
Yeah. I can see that because that's something too, I imagine institutions, sensitive to or should be sensitive to kind of their credit culture. Because as I said in my opener, this is a crucial asset group for them, both from an earnings perspective and a risk perspective. And on the lines of risk, I'm just curious, do you ever see signs of increasing risk? Just like indicators that, okay, not necessarily directly tied to culture, but just what's happening in their operations or activities is kind of leading to, okay, you're moving yourself into a new risk category.
We do see that from time to time. Obviously, you can look at past dues and kind of get ideas, see where the past dues are going. But as far as, if they're going into a new line of business, did you start doing some marine financing? Did you start aviation financing? Did you get into rolling stock, automobile financing? There's a lot of different things that should say, hey, we're doing something different. We want to make sure we're looking at it. And then obviously turnover. Did you have, We've had several institutions where we've had a lift out of an entire lending team out of an organization and they just leave and go to another one. Well, that's a portfolio that's no longer being managed. Same time, did you bring in a bunch of new lenders and have you really checked to make sure that they're doing what they're supposed to be doing? So we say we pick on everybody equally when we do our exams.
Yeah, but it probably does help you help them know where to focus. When you get a sense of just how easy is it to get the documentation we need to do the services this financial institution needs, and then also kind of what am I seeing? Let's make sure it's not just going through that checklist, but really responding to their environment.
Yeah, well, we're very fortunate in the fact that I have Joseph McCain, who's been on my team for 10 years. We've been together. And Joseph's really good about getting the reports and going through them and then saying, hey, Jay, I'm noticing some trends here or something different. So we can really kind of target one review from the next so they're not the same. We do kind of a branch / borrower lender rotation. So it gives us the opportunity to check some different things, and he's really good at doing that.
Yeah. And I'm kind of trying to put myself in the seat of the leader of a financial institution. And the first thing that comes to my mind is I want to help my community, right? I want to help the businesses and the people in my community with their goals and objectives and see them be successful and be part of the success story. But I recognize there probably need to be some non-negotiables that I keep in mind. Can you just kind of help educate me on what those non-negotiables should be?
Absolutely. And our community banks, they're there to service the community. You know the guy, you know the individual, you know the lady, you know the organization because you see them every day. But the non-negotiable is credit due diligence. You can't skip your credit due diligence. You got to understand what is the question, what is the ask, what are they looking for. We're not going to just write a check and say go do well. So you just need to understand that you have the confidence in who your sponsor is, your borrower, your guarantor. You got to understand what your collateral is. You got to understand have you did your environmental due diligence? Did you get an appraisal? Do you understand what the value is? Those are just things that you just can't skip. And I know in a community environment you want to really help and service that individual, but you got to do both of yourself justice, and you got to do your due diligence.
So it makes sense that I'm starting from the posture of wanting to help, but I need to do what I need to do.
Yeah, I mean, we're all there to service our clients, and whether our clients are banks or their clients or people in the community, we all want to help each other, but we just got to make sure that we're doing it within the parameters and it makes sense, and that we can lower the risk for everybody. Because you could add additional risk to your borrower and not being intentional about it, and that's where the due diligence comes in. It's a two-way street.
That's a really good point too, and in a lot of ways, this is also in the interest of the borrower. We don't want to put them in a tough spot.
I mean, our financial institutions are their professional advisors. We're their professional advisors. They advise the community, so they got to make sure that they have the right information, the right people in place to truly service that community.
Yeah. Now, the next thing I think of as, the business leader of a bank is I want to grow. Anytime you're in business, you want to grow and be successful and not be stagnant. But I do recognize that this is a regulated environment. So what does growth look like for financial institutions? What do they need to kind of keep in mind and monitor other than just grow?
Well, that goes back to those regulatory constraints. So like I said, it was 100% of capital on acquisition, development, construction, ADC finance, 300% on CRE. Just because you hit those buckets doesn't mean you stop. They want more granular review. So in your bucket, if you know that you're loaning more construction in a specific industry, you're doing more multifamily, or you're doing more residential or townhomes, whatever the case is, student housing, things like that. They want to make sure that you're not over leveraged in one particular class, because you got buckets, then you have classes of loans as well. Are you really big into C-stores, gas stations, hotels, motels, liquor stores, things of that nature? They just want to make sure that if you have a niche, which is great, you're servicing that niche, but do you have the controls in place that you're not too over leveraged in one specific industry?
Gotcha. So just like those core concepts that we encounter often in business, like diversification and avoiding concentrations, just really thinking about it from those common business themes, but having maybe some more guidelines than other businesses are used to. And it sounds like we don't necessarily have to manage real strict to those guidelines. We just need to keep them in mind and be aware when we're pushing or crossing the thresholds.
Yeah, and I promise you, if you get too far over your skis, per se, the regulators are going to pull you back. Yeah. And that's what they want. They just want to make sure that you're within compliance of what you're supposed to be, and those guidances have been out since 2006. So they're kind of set in stone at this point. But if you're going to go over them, you better make sure that you've added it and that you have documentation to support that decision.
Gotcha. And that kind of brings me just thinking about like warning signs. Like obviously getting close to one of those and maybe crossing over is a potential warning sign, perhaps. But what are other warning signs I can look at as a leader of a financial institution, or even just when I'm kind of taking a look at my loan portfolio and thinking about my relationships, when I might have a warning sign with one of my customers and clients who I need to start reaching out to. What are things we can do from like just managing warning signs and monitoring those?
If you're one of my clients, you're probably sick of hearing me say it is site inspection, site inspection, site inspection. Go see your product. Go see what you're doing. If you've got a borrower that's doing a lot of construction, how are you managing the construction draw process? Have you if you say you're 78% funded, did you go physically see that there's a roof, that there's a chimney, a sidewalk? I mean, have you looked at these things? You have to control the process, whether it's you're hiring a third party to do it in the construction inspection side, and same thing on the CRE. Go. If you're going to lend in a community, go to that community. You can't lend in a community that you don't go visit. And then on the SBA side, it's a very servicing intensive industry. So a lot of those individual institutions, they'll hire what's called a loan service provider, LSPs, and there's some really good ones in the country, and they'll help them kind of manage that portfolio, because it is even more servicing intensive than say some of the other classes.
So some trust but verify.
Absolutely.
Now, when it comes to just kind of monitoring, for warning signs and looking for indicators, how often should I be doing that?
Well, at a minimum on an annual basis. That's where the annual review process comes in. And we've, you got to, based on each institution, it's going to be different. So, if you're a $250 million institution, you may want to say, hey, any relationship $1 million and above, we're going to go visit. We're going to go talk to them. But if you're a $3 billion institution, your risk profile may say, 2.5 or 5 million. It just really depends on your market, but they need to put that in place. But the annual review process is the hard check and balance. You can't skip that process.
So I'm not necessarily just waiting for like a renewal to hit.
Well, no, and sometimes they'll treat a renewal event as an annual review, which is acceptable. If you had sometimes these borrowers have 5, 6, 10, 12, 15 loans. And, if you're touching that client on a regular basis, that can count as your annual review because you should have an updated approval, an updated credit memo that went through some level of approval authority. And so we do accept those. But, at least on an annual basis, something needs to be happening with that borrower.
Yeah. So we talked a little bit about, just like warning signs we can keep an eye on. But I'm also thinking on the front end too, when it comes to me, navigating whether or not it is a good idea for both me and my customer to issue a loan. How do I kind of think about what a realistic budget is for them versus just, wishful big thinking?
Yeah, projections and budget are very important. So when you're looking at a transaction, the equity. Everybody wants to talk about equity. Debt and equity, they kind of go hand in hand. So if you've got to put 20% down on some real estate, or you got to do a construction loan that requires 25%, or whatever the case is, you want to make sure that you have budgeted cost overruns. That's the number one thing that most people miss is the cost overrun, especially this day and age when we're talking about tariffs. Tariffs can change how much a 2x4 costs by tomorrow. There's a lot of things that can affect your project from the day that you approved it to when you get to that part of the funding stage. So the question is, does your borrower or sponsor, do they have the cash or the liquidity to help fund that overrun? There's going to be overruns. There's always going to be contingencies. So that's when the lender and the borrower have to sit down and say, either we got to come up with some more equity or we have to be okay with adding some more debt. It's got to come from one or two. So you can't get 60% into a project, just quit, because then nobody wins. So you got to at least get the project finished. So the question is, who's going to give what? Somebody's got to give somewhere.
That makes sense. If the project's going to need capital, how much capital do they already have and are they asking for? And when overruns do happen, where will the excess come from? Existing resources, maybe a capital call to the owner group, or we issue them some more.
Yeah, and it happens. We see policy exceptions, and they're documented. You have to provide those to the regulators as well. So we approved the loan at 80%. The borrower went out of cash, but we've got to finish the project, and we're at 90% now. It happens. It's an exception. We just got to report it, understand what happened, and then move on from there.
Perfect. Now I am curious. A couple of times in our conversation, we've talked about some like government-backed opportunities. So will you just help me, double click on that a little bit? What is out there from the perspective of just government-backed loans, government-backed lending that I can kind of think about for our institution, whether that makes sense?
Well, and it's not just our institutions, but as far as some of our clients we have within the firm. So there's USDA and there's FSA that help a lot of the agricultural needs in the communities, that are different programs that can go all the way down to the farm level to just think about the orange juice manufacturer, whatever the case is from that standpoint. Then you have USDA, which is a lot of the job creation. So this is your manufacturing, your equipment, your big capital expenditures. The financial institution is going to fund 50% of that project. The USDA puts in a 40% debenture, which is a second mortgage. So it's not a guaranteed loan; it's a second mortgage. And then the borrower has to put in 10 to 15% equity. They're kind of increasing the equity requirements right now, but the minimum is 10%. And then you have your 7A, which is up to $5 million, which you're talking about increasing a little bit into some specific job creation categories. But typically 7A loans, you can get a 75-80% guarantee. Your loan's protected. Some of them are up to 90%. And that goes all the way down to express loans for $350,000 for some smaller type borrowers as well. So there's a lot of opportunities to put access to capital and credits that may have a little bit of strain. Talk about that community involvement thing. You want to open up that new chiropractic office in a community. Well, this is a loan that will help him. The kid's straight out of college, has just got his doctorate, and he wants to open up a practice. These are some of those programs that really help with those.
Yeah, so it gives us more opportunities to help customers and clients who we otherwise may not have been able to.
Absolutely. I mean, as a banker, the last thing you want to hear is you sit down with a potential borrower and says, "I have little cash, little bit of experience, but I have a great dream and I have a new degree and I want to do something." You want to help them, but you're like, "Well, go somewhere else. I'm not going to do that." This makes sure that we can help those individuals.
Well, do some of my best practices need to stand, or because these are government backed, can I rack it up the aggressiveness a little bit?
We have seen that. We don't like to see that. The answer is no, you shouldn't. They're government guaranteed loans, and if you're not servicing them and there's high risk, I promise you, OCRM, which is the Office of Credit Risk Management, they have flags. They have what's called a Paris score, and when that score starts to increase, you're probably going to get a phone call, and you might even get called to Washington, D.C. to talk about why that risk went up. So there's definitely a non-negotiable. You got to manage that portfolio, because I promise you won't have the opportunity to continue that type of lending very long. I promise you that.
All right, I want to get into some just trends that you're identifying, and kind of the first thing, are there any kind of hot button regulatory issues you've been navigating?
Yeah, we've seen an increase in call code reporting. We've had a couple of instances with a couple of clients, actually, where the regulators have kind of picked on how they're reporting. And one of the biggest common one is an ADC, the Acquisition, Development, Construction. When it's a construction loan, it has one call code that you use, but once it goes to permanent financing, you're supposed to change that call code. Well, additionally, you can change it to owner-occupied or non-occupied, so that's where your CRE buckets come in. So you can literally have one loan that's in this bucket this month, and then the next quarter it's in a different bucket, and we're seeing some not very good monitoring when those happen. So you'll do what's called a construction perm loan. The loan will automatically convert to permanent financing. Well, that's the system generated loan document, part of the covenants thing we talked about. The transfer and the call code reporting sometimes is a manual thing in the operations department that's not always getting called. So we've added some safeguards and some triggers to help kind of pick up some of those. And we've even done some targeted reviews specifically for the call code area.
Because that's earlier we were talking about different buckets of loans, loan types, loan classes, and so call codes are how we're capturing them in the right buckets.
Absolutely.
And then just kind of as different interpretations or best practices shift, we need to make sure we're keeping up with the right codes for the right types of loans. Then also, like you were saying, a loan can change over its life.
Right.
Yeah.
Things evolved, and like ownership, the building may have started out owner occupied, but then the owner decided to move to a new facility and lease out the old one. That bucket just changed.
And now staying on trends for a minute, it just seems like M&A is kind of increased in the financial institution space. Kind of talk me through that. What's something for me as a leader of a financial institution I should kind of keep in mind from an M&A space, especially if I'm looking into either buying or selling or joining forces with another institution?
We've had a lot of that at the end of the fourth quarter, all the way through really mid 2025. We've had a lot of acquisitions come up, and so I think there was a lot of pent-up demand waiting to happen. They want to kind of see what kind of policy shifts happened. But one of the things, is the due diligence side. We talked about pools and buckets. Each institution has a different culture appetite as far as the composition of their portfolio. So you got to identify what your pools are. You got to identify what your buckets are. Then you can kind of run some models and decide where is your pain points. I want a little more due diligence in this bucket. They're really heavy in this type of lending. And so it'll kind of help you go through and identify what kind of due diligence parameters you need to talk about. One of the other things that we look at is, we look at their watch reports. We want to know who's on it. Watch or worse, we're going to pick those loans first. We're going to look if the loan were to continue to deteriorate, is there a potential loss? What happens if it does wind up going into a foreclosure situation or litigation situation? We're not going to tell you what that loss is. We're just telling you there's an opportunity here for you to identify what that loss is. And so those are just some of the buckets that really, really are important on the front end.
Now, what about like post-transaction? Kind of thinking like the 90 days after I buy or sell. What are the things I should be keeping in mind?
Well, the post-transaction is you have a lot of management turnover. So when you're acquiring a portfolio, you have lenders leave, you have change of executive management. There's a blending or a hybrid of a marrying of the institutions, if you will. Roles and responsibilities change. this is when the portfolio typically kind of gets less looked at. We all send out reports. We're all asking for information, but are you managing it at the loan level? So some of that identification, you've got to be self-aware of what they are, and this is where those client check-ins are very important. So if you're going to have some lender turnover, or you're potentially going to lay off some staff, whatever the case is, you just need to make sure that you've got out and you got to meet with those borrowers, because that you can't beat it at the relationship level. You're going to have losses. You're going to have mistakes. Things happen. The due diligence process up front is what helps minimize those.
Yeah, so have that diligence up front, think about things you think about, and then also just kind of keep an eye on those considerations afterwards to ensure it's all smooth. Well, Jay, I had so much fun this conversation. I really appreciate you joining me on the microphone to help talk through these considerations for me. And to our listeners, thank you so much for tuning in. If you have any follow-up questions about the financial challenges we discussed in today's episode, or any other financial challenges you're navigating, please do not hesitate to contact us at www.mjcpa.com.